Welcome to my channel, your ultimate destination for mastering finance and business management. Whether you're looking to grow your wealth, build your business, or sharpen your skills, we've got you covered with practical tips, expert insights, and actionable strategies. Let's embark on the journey to success together. The smart way to dominate ETFs in 2025. Are you ready? What sets you apart as an ETF investor? Thinking differently for financial success. Explanation: to dominate ETFs in 2025, you can't follow the herd. Most investors chase trends, mimic strategies, and rely on outdated methods. But the real winners in ETF investing are those who think differently, adapt to market conditions, and align investments with their personal goals. Being cut from a different cloth means taking a personalized, calculated approach to your ETF strategy. You don't just invest for the sake of it, you invest smartly. Example, take Sarah and James. Both started investing $500 monthly in ETFs. Sarah followed trending thematic ETFs like tech and green energy, while James stuck to a diversified portfolio of index funds. When the tech bubble burst, Sarah's portfolio lost 40%, while James's steady strategy kept him on track for long-term growth. Understanding the ETF landscape in 2025. What's changed in the ETF world? Explanation: the ETF market has grown exponentially, with options for every sector, theme, and strategy. In 2025, investors face unique opportunities and challenges. New sectors, AI, green energy, and blockchain are dominating thematic ETFs. Increased competition, low-cost ETFs are pushing out high-fee products. Regulatory changes, governments worldwide are increasing oversight on financial products, impacting ETFs. Understanding the current landscape is crucial to avoid pitfalls and capitalize on emerging trends. Example, in 2023, a popular ETF saw massive inflows during the hype, but lost value when the tech sector slowed. In contrast, diversified ETFs like S&P 500 funds maintain steady growth, proving the value of long-term strategies. Choosing the right ETFs for your portfolio. The power of selection. Explanation: with thousands of ETFs available, picking the right one can feel overwhelming. The key is to align your choices with your financial goals, risk tolerance, and market understanding. Define your goals. Are you investing for growth, income, or stability, short-term or long-term? Analyze ETF metrics. Expense ratio: lower fees mean more of your money stays invested. Liquidity: ensure you can easily buy and sell. Performance: look beyond short-term gains and analyze historical trends. Example, Alex wanted a tech-heavy portfolio but chose ETFs with high fees and low liquidity. Over time, his returns were significantly reduced compared to low-cost, diversified funds like the S&P 500 ETF. Mastering thematic ETFs. Investing in trends without the risk. Explanation: thematic ETFs offer exposure to trends like renewable energy, blockchain, and robotics. While these can deliver impressive returns, they come with higher risks due to market volatility. Key to success: research the theme's long-term viability. Avoid chasing hype, look for sustainable growth trends. Diversify within themes. Instead of going all in on one thematic ETF, balance your portfolio with stable, broad market ETFs. Example, in 2022, investors who went all in on clean energy ETFs saw losses during a sector downturn. Those who balance clean energy with broader market ETFs experience less volatility. Balancing risk with diversification. The golden rule of ETF investing. Explanation: diversification spreads your risk across different sectors, geographies, and asset classes. The key is balancing high-growth ETFs with stable ones to protect your portfolio during downturns. Global exposure: invest in international ETFs to hedge against local market risks. Sector balance: pair high-growth sectors like tech with defensive sectors like healthcare or utilities. Example, Emily's portfolio combined US tech ETFs with European dividend ETFs. When US markets dipped, her European ETFs provided stability and consistent income. Dollar cost averaging: the foolproof strategy. Investing consistently, regardless of market conditions. Explanation: dollar-cost averaging DCA involves investing a fixed amount at regular intervals, regardless of market performance. This strategy reduces the risk of buying high and ensures you're consistently building wealth over time. Why it works: eliminates emotional decision-making, captures market dips and reduces average cost per share, DCA in action. Set up automatic investments in your chosen ETFs to stay consistent. Example: John invested $200 monthly in an S&P 500 ETF. During market dips, he bought more shares at lower prices, boosting his returns when the market recovered. Managing fees and taxes like a pro. Keep more of your money. Explanation: high fees and taxes can silently drain your portfolio. The smartest ETF investors minimize these costs through careful planning. Reduce fees. Prioritize low-cost ETFs with expense ratios below 0.0%. Tax-efficient investing. Hold dividend-paying ETFs in tax-advantaged accounts like TFSAs or SPS. Example: by holding high-yield ETFs in a TFSA, Mike avoided paying taxes on his dividends, saving thousands over a decade. Active versus passive ETFs. Which one should you choose? Understanding the difference and finding your fit. Explanation: the ETF market is divided into two main categories, active and passive ETFs. Both have their merits, but choosing the right type depends on your investment goals, risk tolerance, and market knowledge. Passive ETFs track a market index, for example, S&P 500, MSCI World Index. Lower fees, less risk of underperformance, and ideal for long-term investors. Active ETFs, managed by professionals aiming to outperform the market. High fees and more risk due to the reliance on fund managers' decisions. Example: Anna invested in a passive S&P 500 ETF and watched her portfolio grow steadily over 10 years. Her friend, Mark, chose an actively managed tech ETF. While Mark saw high gains during bull markets, he faced sharp losses during downturns, highlighting the risk of active funds. Spotting emerging trends in ETFs. How to identify the next big investment opportunity. Explanation: ETFs are evolving rapidly, with new themes emerging every year. To dominate ETFs in 2025, it's crucial to identify trends early and separate long-term opportunities from short-term hype. Tools to spot trends. Use resources like Morningstar, Bloomberg, and ETF screener tools to analyze sector performance. Follow market news and reports on emerging industries like AI, renewable energy, and healthcare innovation. Evaluating trends. Assess whether the trend aligns with long-term macroeconomic shifts. Avoid overcrowded sectors that may lead to overvalued ETFs. Example: investors who identified the electric vehicle trend early in 2020 benefited significantly from ETFs like DIV, which tracks companies involved in EV production. However, those who joined the trend late faced losses as the sector corrected in 2022. Building a resilient portfolio with ETFs. How to balance growth, income, and stability. Explanation: a resilient ETF portfolio balances growth-focused investments with income-generating and defensive assets. The goal is to protect your portfolio during downturns while still achieving growth over time. Core satellite strategy. Core ETFs, broad market index funds like the S&P 500 or MSCI World Index form the foundation of your portfolio. Satellite ETFs, add thematic ETFs, sector-specific ETFs, or actively managed funds to capture higher returns. Rebalancing, regularly adjust your portfolio to maintain your desired allocation. Example: David's portfolio has a 70/30 split between core and satellite ETFs. When tech ETFs outperformed in 2023, he rebalanced to avoid overexposure, ensuring his portfolio remained diversified and stable. Common ETF mistakes to avoid. What could be costing you thousands without realizing it? Explanation: even the smartest investors make mistakes. Recognizing these common errors can save you from costly missteps. Over-diversification. Holding too many ETFs can dilute your returns and increase management complexity. Chasing past performance. Just because an ETF performed well last year doesn't mean it will continue to do so, ignoring fees. High expense ratios can significantly reduce your long-term gains, especially in actively managed ETFs. Example, Emma owned 15 ETFs across various sectors, but realized that her portfolio overlapped significantly. By consolidating into 5 well-diversified ETFs, she reduced fees and improved her returns. Final thoughts. Your blueprint for ETF domination in 2025. Explanation. Mastering ETFs requires a mix of strategy, discipline, and ongoing learning. By following the principles outlined in this video, you're setting yourself up for long-term success in the evolving ETF landscape. Recap key strategies. Think differently and personalize your investments. Use dollar-cost averaging to invest consistently. Balance your portfolio with growth and stability in mind. Encourage continuous learning. Stay updated on market trends and emerging ETF themes. Regularly review and rebalance your portfolio to align with your goals. Call to action. Are you ready to take your ETF investing to the next level? Share your thoughts in the comments below. And don't forget to like, subscribe, and hit the bell for more videos like this. Thank you for watching Saprik Your Finance. If you found this video helpful, don't forget to like, share, and subscribe. Hit the bell icon so you never miss our latest insights on finance and business management.